As mentioned in a previous video, the typical length of a private equity fund is about 7 to 10 years, and may have a year or two extension. But what if, towards the end of the fund life, the fund owns investments that still have opportunity to grow? What if, towards the end of the life of the fund, there are investments that may not be facing the most optimal time to sell it because there may be something against the industry, or maybe the economy is not doing well? What if the investors into the private equity fund have a really long time horizon? Because of these questions, there has been a growth in longer life funds. Longer life funds give GPs added flexibility because of the elimination of time constraints. As well, longer term investments have less volatile returns. And as an added benefit, GPs don't have to fundraise as often, and therefore they can focus on deal sourcing and execution. Carlyle, CVC Capital Partners, and Blackstone have all raised longer life funds. Blackstone recently raised its first longer life fund, which raised $5 billion for a 20-year lifespan. Joe Baratta, the head of private equity at Blackstone, is quoted as saying, "I don't know why Warren Buffett can be the only person who can have a 15-year, 14% sort of return horizon." Fun fact, one of the first private equity firms to raise a longer life fund globally is right here in Canada. Altus Partners, located in Toronto, raised a $1 billion fund in 2016, which allows investments in portfolio companies for up to 17 years. That fund has a unique compensation structure in where it only charges investors on capital invested instead of capital committed.